Today's lecture deals with side effects and opportunity cost. When we look at side effects and opportunity cost, we're really looking at how does our project impact the rest of the firm, and also what choices or what opportunities do we give up when we take on a project. In other words, are we giving up potential cash flows that could be made elsewhere? Well, why is this different from accounting? Well, when an accountant looks at a project or looks at a firm, he really looks at the performance of the firm, the sales, the earnings, the expenses. In finance, of course, we do this as well, but we also want to look at the big picture. Does the decision I make impact other parts of the firm? Am I giving up other potential opportunities? An opportunity cost is something we give up when we make a decision. In other words, it's the next best opportunity or next best alternative when we look at a project. For instance, if I'm doing a project, I may have to use equipment or machinery that I could otherwise sell if I say no. So in other words, by taking on a project, I'm losing the opportunity to sell this equipment. Another example would be, say, a piece of property or a warehouse or building that I have to use for a project. I might be able to sell or rent out the space if I'm not invested in this capital budgeting project. Now, like everything in capital budgeting, we want the cash flow. So when we look at an opportunity cost, we want the net cash flow that I am losing or giving up. So the value of the next best alternative. For example, suppose a new project will use some existing equipment that we could otherwise sell for $2 million today. So in other words, we need this equipment for the project, and we could sell it for $2 million today. Well, $2 million is the market value of the equipment. It's not the cash flow. If you remember from a few lectures back, we pay taxes to the government when we sell a fixed asset. So I can sell this equipment for $2 million. The key here is it tells me that the equipment's been fully depreciated. So that means that the book value of this equipment is zero. So we need to do a net salvage value calculation, and that will let us know the opportunity cost of using this equipment. Hit pause if you want to read through the explanation, but look at the calculations below. We use our net salvage value equation, where it's market value minus taxes, where the taxes are determined by the tax rate times the gain. Well, when I sell this equipment, or if I did sell this equipment, my gain would be $2 million minus 0, or $2 million. So my taxes would be 40% of that, or $800,000. The net salvage value then is $1.2 million. So if I decide to invest in this project, I'm losing this opportunity or giving up $1.2 million. A second type of impact to consider is a side effect. Now, when we do projects, a lot of times it affects other things that we do. For example, let's say that the Coca-Cola company decided to release a new diet drink. And let's say it's flavored with orange or something such as that. Well, Coca-Cola's sales of this new diet drink might be great. But most likely, some of their new customers would be customers who used to drink Diet Coke or Coke Zero or Diet Coke with a lemon twist, any of their other products that they have on sale now. So by gaining one customer, they've lost a customer elsewhere. We call this a side effect. And that would be an example of a negative side effect or a substitute. So if you see at the very bottom bullet point, if accepting a new project decreases sales for existing projects or products, we say the projects are substitutes. Now let's think of a positive. Suppose that when let's not use Coke, let's use someone else. Let's say Nike Golf. Now when Nike Golf started first working with Tiger Woods, they started out with golf balls and golf apparel. So it's shirts, shoes, hats. Now they start entering the equipment phase with putters and clubs. So these are all interrelated products that help each other's sales. So they help complement each other. So that's an example of having a capital budgeting project where sales of the new product help everything else. So here on this slide I mentioned Nike Golf again. I also have another negative side effect with McDonald's. So feel free to review those. When we look at the full cash flow equation, here's how side effects get impacted. We put them out at the end. Now remember, this is a net cash position. Okay, so the net cash impact. We always want the lost cash. Okay, so if we see an example where, let's go back to our Diet Coke, where the Diet Coke sales are affected by a new product, we want to translate those sales to cash flow. And we'll show a few examples later on that do that effect.